And not a pretty day on the local market. Earlier I spoke to Marcus Padley from Patersons Securities. Well, Marcus Padley, the resolution on the US debt ceiling impasse failed to inspire the local markets, really. Was that much of a surprise?
Well, it was really. We went up 73 points yesterday in anticipation, and when we went home last night, the Dow futures were up 190. So to see the Dow down 10 has shown us that nobody's really impressed by the debt deal at all. And I think the main concerns are that it's going to impact on growth in the US. And after they just downgraded their first quarter GDP number from 1.9% to 0.4%, and the second quarter GDP number came in at 1.3% below the 1.7% expected. Everyone suddenly got the heebie-jeebies about what US growth is going to do, and even if they do this debt deal, whether it's really done anything. And there's in fact one Nobel laureate professor who tells us that it's a disaster of a deal, and in fact is going to damage the debt profile in the longer term. The other issue is for the next week or so we're going to be on tenterhooks wondering whether one of these credible or incredible rating agencies are going to downgrade the US AAA rating, and that obviously is going to have another effect. So yes, completely unimpressed with the debt deal would be the reaction today.
Now on the local market, little surprise I suppose that the Reserve Bank has left rates on hold, but a very different reaction between the currency markets, the interest rate markets on the one hand, and the equity market.
Yes, bonds went up and the Aussie dollar went down, and I think that's implying interest rates are going to go up and down at the same time. And I think really what happened was the RBA have told us that interest rates are on hold, and that's what the brokers are reflecting. No one expecting a rate rise now until next year. There's obviously, after the higher than expected inflation number last week, there were some expectations that we could see a rate hike. We were factoring in a 15% chance of a rate hike. That hasn't happened. But at the same time, rather than this high-profile forecast that we're going to see interest rates cut by 1% in the next 12 months, the RBA have gone the other way and said they remain concerned about the global issues and still have an eye on inflation. So it really doesn't look like a rate cut's on the cards either. So on hold was the message.
Well, to a couple of stocks, and Katmandu had sales figures out. What did investors make of it?
Yeah, well, Katmandu's a Kiwi retailer, of course, over here, but they seem to be on their own in the retail sector. Their profits are going to be up 31 to 36% this year, up 16% like for like. It seems the weather has suited them. I'm not sure whether that means the weather's been terrible, because everybody goes out and buys adventure outfits and that sort of stuff. But the stock has been up 55% since late last year, against stocks like JB Hi-Fi down 32%, and Harvey Norman down 45%. So I'm not sure we can read too much into it. Brokers have upgraded Katmandu by 7% for this year and 3% for next year. So good for them, but not sure it means much.
Now, Rio Tinto has half-yearly results out on Thursday. Any thoughts there?
Well, they've just had production numbers and they had investor presentations, so I don't think they're going to surprise too much. The iron ore market's been strong, and if you look at the best performing and worst performing stocks in the last 12 months, it pretty much tells you what's going to do well. Out of the top 20 performing stocks in the last 12 months, 14 of them are resources stocks, and the others are healthcare stocks. And the worst performers, which is pretty much a reflection of what you'll see in results, have been steel stocks, media stocks, retail stocks, and anything impacted by the US dollar. So if you want to be guessing what the results season is going to look like, I think you pretty much go with that trend. Resources will be okay, Rio will be okay, BHP will be a record, and most of the industrials will be pretty crappy.
And from an investment strategy going forward for the next 12 months, would you recommend the same sort of line?
Well, you have to. It's too cute to say in the stock market that everything's going to turn on a sixpence to suit some miraculous investment. You can only really expect a continuation of the same, which means, and I would guess anyway, US dollar continuing to go down, Aussie dollar continuing to go up, and nervousness for the consumer and resources being held up by China. Those themes likely to remain, I think.
Marcus Padley, thank you very much for joining us this evening.
My pleasure, Tiki.